Hi, this is Dan Collins, Editor-in-Chief of Futures Magazine for Traders Exclusive, coming to you live from the floor of the Chicago Board of Trade on October 9th, 2014. A very interesting time. We just saw a huge rebound in the S&Ps yesterday that most people attributed to the Fed minutes coming out from the most recent meeting. Seems pretty odd because the Fed has really narrowed in the analysis of when they will actually begin tightening to the middle of 2015. A year ago, Janet Yellen caused some controversy by saying they could raise rates as soon as 6 months after tapering is over, and which seems soon. But when you look at the facts, we're going to end. We believe tapering will end the next Fed meeting at the end of this month, and 6 months would put it beginning of the second quarter. So that's not that much in front of the middle of 2015. I think the bigger question in terms of the Fed is how are they going to tighten? Because if we're in a strengthening recovery, can you gradually do 25 basis points? As we mentioned well before that, in past recessions, 2-3% was a bottom. So if we're keeping rates lower longer and the economy is improving, and by 2015 is a full-fledged recovery, what kind of a impact will moving the Fed funds rate from 0 to a quarter to half, 3/4, 1%? I think at some time they're going to have to be a little quicker. A bigger worry right now is this is the month of October. This week and the rest of October, there are a lot of technical points that are a little scary, seeing that it's a month of Halloween for equity traders. If you look at futuresmag.com, our technician, Jeff Greenblatt, aka Fibonacci Man, had put out some very, very interesting time price sequences that are coming due this month. Kind of scary. A lot of people thought that's what we might have been seeing earlier this week. Does the rebound mean that's over? Not necessarily. You see in the worst bear markets, you've seen the reverse of what you normally see. And instead of slow movement up and quick movements down, you see more gradual movement down and spikes up. That's what happened in 2009. So we're not out of the woods. So everyone should use options and protect all their positions, because we see volatility picking it up, and it's due to pick up. But going back to the Fed, I want to look at some of the analysis, because when I said the key isn't when they go from a quarter to a half to one, it's how they raise it. They're gonna start tightening in the middle of 2015. I think that's clear. If things look better, it's going to be the beginning of the second quarter. If things look worse, it'll be the third quarter, as late as the third quarter. But how high will they go? According to recent Fed analysis, that they project interest rates to go, they raised it from 1.13 to 1.375 for the end of 2015. So that means that they see things picking up better, but it's still not huge. By the end of 2016, they forecast 2.875%. Still pretty accommodative, and not till the end of 2017 at 3.75%, which they now target as the normal rate. If you recall, when we were tapering up 1/4% several years ago, the question is, what is normal? And it fell between about 4 3/4 and 5.5%. Well, we've been in this extraordinary period for Fed policy for 6 years, so we really don't know what normal is right now. But if things do start improving, the question is, can they start ticking up more, a half every meeting, or quicker? And will they need to? So keep in touch. Look at futuresmag.com about the technicals. Gold's at a triple bottom. A lot of interesting technical points right now. So when someone comes out and attributes something to Fed minutes where they've already put something out, I don't know how much I believe that. Markets came down sharply. It was due for a correction. It happened. Back up. Does this mean that the sell-off was nothing? That's yet to be seen. This has been Dan Collins for Traders Exclusive. Keep on looking at our technical outlook on futuresmag.com.